Hi, this is a quick video on how to download stock prices and do preliminary analysis and create a very simple portfolio to assets. And this will be a video to help you with the assignment. On Thursday we tried to do it in the class, but during the class, but the problem was that we had a lot of technical problems and some of you guys didn't manage to do practical with me what I was showing on the projector. So what we do is now I will quickly record a video so that it will replace the whole 1 hour long sort of practice. And it was a 1 hour long video as well. I decided not to upload. Rather I will make a short one just in 1 month. So first thing is first you have to first decide what company you want to look at. Here let's say we'd like to look at Walmart shares. And so this is the one here, wall, so the figure code, so just type it in here, and once you go to finance.yahoo.com, now from here you need to go to historical data, and here in the time period you have to select the time that you are choosing for your analysis. So here let's say we start from 1st of October 2014 till today. Yeah, done. Well, it says no. Well, this is fine. Start date is actually prior to the end date, but it's not allowing to do that. So let's calculate and do it again. Yeah, done. So these are issues that you may face, but make sure you just repeat the process and you will get the right, correct, functioning website. And I hope. So the frequency now we would like to have monthly. And you will have historical prices. Yeah, apply. I hope it will print. Yeah, it will show me the full range, so it is doing that. So now once it's done, ignore the dividend payments. They are all adjusted in accounted for in the adjusted price. These adjusted prices. So next thing is click. You could see that as well difference. You see the closing price on the 1st of August 2016 was this much, and when it's actually this is paid on the 10th, so this is really interesting. We have an adjustment here, so you see closing price doesn't match that just close, but it actually doesn't match in many cases. It looks like they adjusted prices for some other changes in stock prices or changes events on that day, on these days, but this is actually monthly prices, so there could be a lot of changes made to this project. Anyway, so for now, download the data. Let's save it somewhere that you want to come back to. So let's save it as wall. This is in my original here. Done. Now I'd like to have second company. So let's search one more time. So we go, where is the lookup? It doesn't have for some reason, but let's try Cisco. Yeah, here we go. It's Cisco Systems, and let's again change this to 14. Hopefully it doesn't give me any other problems. Apply. Yeah, now download. Let's call this what's this, Cisco. Now if you open this file, so let's start with opening the Walmart prices. We don't need all this, so delete that and call this wall, actually WLM, and then Cisco. And here we will only need this copy. Now we can close this, we don't need to, and paste it here. Actually, it didn't save, by the way. I might have cut it actually instead of copying, because if I copied it should have saved it in the clipboard, but it didn't. So let's go back. So I'll just copy now and then paste it. And this was Cisco, yeah. is, well, I don't remember the difficult, but that's fine. Now we'll have to now sort this series by date so that the starting earlier dates are at the top and the later dates are at the bottom. So we will go to data after highlighting this area, sorts. Now you see it now excludes, sorting excludes all the headers because this is text. If I untick, you get view here. So sort by date, okay, and here we go. We have the prices sorted now. As you can see, Walmart from 72 to 72. So there's little change, little value gain between bought here and sold here. But there's a lot of fluctuation here. If you sold here your shares, you will have gained about $9 gain per share. So here there's a big difference here. It's gradually increased to 39. So anyway, so now here we have to, this is CSV extension, you see. So you have to save it as Excel to do any further analysis. So let's see if I can save it. So XLSX. So call this risk return. It's a practical, so you can call it anything. Now these are stock prices. Usually we deal with returns, so you have to calculate the returns. So we call WLM and Cisco columns and create. And let's create a return. So we'll be using log returns, as you know. So this would be the ln of the price 2 divided by the price 1. So price 2 being the price, next day's price. So this is basically a way of calculating returns that we usually use using the growth formula. If you remember, the formula was P2 minus P1 divided by P1, right? So this would be capital gains growth rate. However, we use ln as an approximation to this. Next thing is to start analyzing the return characteristics. So let's start with calculating the mean return, standard deviation to measure the risk, and 2 columns. Right, so mean is calculated using the average function, so equal average, double click on it, highlight for Walmart, enter. Okay, this is giving me non-standard decimal places. So now next thing is to calculate standard deviation for Walmart. So it's STDF. Yes, some. Yeah, it stands for sample. So we like to have a proper looking average return. So I'll just go and do the usual percentages. Yeah, right. Click percentage sign, and let's see. Yeah, this will be enough. Very small amount of return over this period. So this is the average return. If you held your cash in Walmart stocks, this would be the average return you gain during that period. Now what we do is we just copy this formula by highlighting and dragging from the bottom right hand corner to Cisco. So that gives us something better looking return and risk profile. This is basically high risk, high return sort of case, but the risk is not increasing by a huge amount, but return is huge here. So depending on events that affected the stock price, you will get in this period different return risk characteristics. But what is important here is the what happens if you put these stocks together in a portfolio. Will I get higher return than the two, or something between them, but still minimize the risk? So that in the sense that I want to minimize this risk volatility, but I want to have higher return, whether it's between the two or higher. But usually in a portfolio analysis, the portfolio returns from the individual stocks will be between the lowest and highest returns of individual stocks. So one way to look at to start is to start looking at the correlation, variation between the two stocks. So usually that's correlation. So equal correl. So double click, highlight the first comma, highlight the second, and close the bracket. Well, this is very weak correlation, which is a good sign. I mean, we would like to have less correlation between the two, because we want to, what we want is in a period of when Walmart increases, Walmart prices, stocks appreciate in price. We would like to have Cisco. Sorry, this is a bit of, I should tell you the opposite to make sense, for it to make sense. When Walmart shares, for example, decline in price, we would like to have some compensation for these declines, some sort of gains. In that case, we would expect Cisco stocks to go up, so that loss in Walmart is compensated for by appreciation in the Cisco stocks. That's why we prefer a negative correlation, or low correlation, or no correlation basically. So, and this would give us efficient diversification as well when the correlation is not strong and positive between the two. You can have a look at the correlation, graph as well, how it looks basically. So if I go to data, insert, go to scatter graph, right click, select data, add. Now here I could say correlation Walmart, and let's say this is Cisco. X ranges, I could put Walmart or whichever one want to put. It doesn't matter here. Y range, because we are not doing deviation at this stage. Cisco. Okay. So this tells me, I mean, I don't see pattern here. There is no systematic pattern. You see, not all these points are lining up upwards or downwards. It's just chaotic pattern here. In other words, it's random. So this actually shows me. I mean, this is indication. I mean, this low correlation basically implies this sort of picture. This sort of correlation graph, correlating values. So that makes these two, when put together into a portfolio combine it into a portfolio of shares, they make a very efficient portfolio. So we can try and see that now. Okay, let's create portfolio. Let's say portfolio. Now, portfolio mean is basically the rates of the fraction of money I want to invest in Walmart times the Walmart returns plus the fraction of money I want to invest in Cisco times the Cisco returns. Let's say I have £100. I'd like to invest 80% in Walmart. Well, it's negative return over that last period, so I would expect that in the future it will carry on performing poorly, so I would like to invest only 20%, let's say, times the Walmart return, plus I would like to spend the remaining cash on Cisco investment, so times Cisco return. That gives me a return, a 1% return on average during that period, which is actually not bad, higher than Walmart returns, but a little lower than the Cisco returns. Now let's say, what's the standard deviation now? Am I getting low risk for this sort of return now by combining? We will see that. And the formula is a bit complicated, so you have to just type on this formula now. Now this would be the standard deviation squared for Walmart times the fraction of cash I am putting in Walmart squared, so that's 0.2, plus 2 times the fraction of Walmart times fraction of Cisco times the covariance between the shares. This will be correlation squared basically, plus Cisco squared, Cisco standard deviation squared times 0.8 squared, which is the fraction I put in Cisco shares. So let's say I didn't make any mistake here. Okay. Well, this is very good. You see, this is a huge reduction in risk by combining these two into a portfolio, these two different stocks. I actually managed to reduce the risk by so much. Look at this, it's 5.6% variability here and 6.8%, but here it's less than 1% variability for a given high return. I think this is a very efficient portfolio. And you will see that when you add the third stock, this will go down while this may go up or not, but basically essentially goes down as long as the correlation is not high between 2 and the third stock, basically. So that's an important finding, isn't it? So you will now carry on doing the rest of it. I mean, with your own chosen stocks, and experience and see sort of how things work in the risk-return trade-off process, or when choosing the stocks. One thing that I want to talk about is the covariance and correlation. Basically, we started talking about it, but I don't know how good how good the explanation was, or how well you understood it. But I want to give a bit more clarification on that. So basically, covariance is the same as correlation. They both measure the covariation between stocks. In other words, if one goes up, it measures the reaction of the second one, for example. It just measures how the two shares co-move together. Now, covariance will be a huge number usually. If I square this, for example, if I square this, it is the covariance between the two stocks. But what's problem with this is just that this could be a huge number as well, and low number as well. There's no benchmark. There's no way of comparing covariance between two sets of stocks. But when you square root or take the square root of covariance, you get correlation. And the thing about correlation is that it can only take values between -1 and 1. So there's some interpretable sort of numbers, figures you get after correlation calculation. You get some interpretable numbers there, kind of meaningful numbers that you can use to interpret or to put meaning on the relationship. So we will be using correlation, and we'll be looking at correlation. So because it gives us some sort of it enables us to interpret the relationship between the two shares. We could be able to see how strong the relationship is, association is, or how weak it is, or many other aspects of this relationship you may be able to look at, analyze by looking at the correlation coefficient. Okay, so we will discuss the rest of it in the classroom. I think this is a fair amount of time I spent on just this practical. So I would expect you to carry on analyzing, carry on adding more stuff here before you do the portfolio analysis, or maybe you just do the portfolio analysis by adding stuff at time. See how it goes. Create the correlation graph and see how it goes. If you want, you could create a histogram of returns and see if the returns are normally squared or not. If the returns have fat tails, if they have fat tails, this is an indication of sort of uncertainty and risk of getting high or low returns. Okay, see you in the class, and maybe in the next video, another one if I record another video.